Hello, everybody. Thank you all for the early birds who queued up and were patient with us. And thanks. I'm really excited about today's kind of Q&A fireside chat. I don't know what they call these things anymore, but I am joined by John Sechrest from the Seattle Angel Conference. I would say from far more than the Seattle Angel Conference, from a lot of things that are going on in the early stage and angel investing world. We've done some mutual events and programming. Oh, I'm Ryan Nash, by the way. I'm the COO at Gust. Um, on the invite list, John, is all of our Gust launch customers as well as a part of our broader network. So people who have signed up and used our tools, whether looking for accelerators, angel groups, getting feedback on the state of their venture, and anywhere in between.
Cool.
So the angel conference model is something that's been really exciting for us. We've done some events with John, and it's just a cool presence that I don't think enough people know about in the space as a very interesting way to both get companies funded, to increase, the connections and network in early stage in investing, as well as just that increasing the serendipity surface of what really happens in business and moving from one, an idea to something that's actually building some traction and some momentum. So I'm going to let John introduce himself because he knows more about his storied career and connections in the space. But I will preface it by just saying, as we've been working with Seattle Angel Conference, the one thing I've been hearing over and over and over, and I've attended some of their events, even some of their recent IPO event, which was kind of cool for one of their companies, is people like get in John's orbit and they don't leave. They're like, oh, I've been with John for 10 years. I was in the first Seattle Angel Conference. This is my 15th conference and things like that. So I'm excited to have everybody here to introduce John and the whole program. But John, give us a bit more of your background, your history, and kind of the history of the Seattle Agent Conference too.
Cool. I started out as a software engineer, did Hewlett Packard kind of thing, did system administration thing, and ended up backing my way into starting an internet service provider, which sort of taught me business the hard way, right? Running fast into trees. And I ended up becoming the economic development director for a small city, which the goal was, how do we get startups going in our city? And I took a copy of the Ben Venture Conference and put it into Corvallis, Oregon. And that methodology has served very well. And so now I've been doing it for over 15 years, helping people figure out how to become angel investors in a learning by doing kind of context, but at the same time giving feedback to the startups about why they're not making the progress that they think they should be making. So everybody in the program makes some progress. We run it twice a year in Seattle. We've been running it for 10 years. This is the 21st Seattle Angel Conference. We gather 40 investors. We gather 50 companies. We do American Idol meets startup. And then we do a month of due diligence on the six finalists. And then we have a demo day where we pick which one is going to get the investment. In the end, the 40 investors create an SPV, which then invests 200,000 in one of those companies, or maybe two or three of those companies if they get overly excited about one of the companies that doesn't get selected as the winner. But this is part of a broader conversation of going from, I don't know anything, I want to do a startup, but I don't know anything, and we do open coffee for that. And then really, you don't need money, you need customers, and we do Lean Startup Seattle for that. And then we facilitate Startup Weekend because people need to practice skills, and they need to practice roles, and they need to date co-founders. And so I don't think people do nearly enough practice in the co-founder dating and using new skills and using new tools as they could in startups before they get going. And then we do the angel conference to make new angels. And then we have a fund manager peer learning group for angels that are trying to professionalize. So building that whole arc of, I have an idea and an entrepreneur, and I win at angel investing and now, or as a startup, and now I become an angel investor, and then I win at angel investing and now I start a fund, right? And build that ecosystem that builds a positive feedback loop where we get better and better in our local economy. And we helped San Diego, Oregon, Washington, British Columbia, and Alaska all put things together. And now we're looking at doing transatlantic angel conference and a Barcelona angel conference. And because we've been locked in this green room for a couple of years, the companies anywhere from North America to participate in our program. And so we've seen quite an interesting range of companies, Georgia and Pennsylvania being the ones that sort of stood out as providing a lot of companies that we didn't expect.
Huh. I have a couple questions, and I will. I forgot to say to the audience, this will be open Q&A at any time. I'll be watching both the chat and the Q&A functionality. So if you have any questions about any of the topics that we talk about, feel free to ask them in there. If we need more clarity, I'll pull you up, but I'll kind of interstitch them based on the topics that John's talking about, or even address them in the chat. I did want to ask a couple questions about the great background that you just gave. So I can very much resonate with the like founders are not asking the right questions usually. They come into the space, they're full of passion, drive, and energy, usually to solve a problem that is actually quite personal to them or something that they have a deep domain expertise in. And usually the next question, and this isn't any kind of fault, it's such a weird and unknown space sometimes if you haven't been in it. The first question is, well, how do I get funding for my idea? It's like, oh, well, what maybe you should actually think of, is there a market for your idea? Are there customers for your idea? Is this a problem that they have? And at Gust, we used to be pretty much just an angel group platform and then an accelerator common application platform kind of. And lately, if you've been around the Gust ecosystem the last couple of years, we've changed a lot of that because we weren't providing value to those customers, because it'd be like, I have an idea, I want to get funding. So I go to the New York Angels and I apply and I hear nothing back ever, because the New York Angels are only investing in companies that have hit revenue. They're only investing in later stage companies. You just fall right out of the funnel, and a lot of angel groups don't even give you feedback. One of the things I like about the angel conference model so much, and maybe you could speak a little bit more in depth in what it looks like as a founder to go through it, because I know you start with a big chunk and then it kind of narrows down a funnel, but they're very holistic in the approach, I think.
Yeah, so we start actually with workshops. So in our meetup group, and I'm having problems typing into this little small fonty thing here.
Oh yeah, make it all entire audience. You're sending just to the organizers. I'm just seeing that. Hit the picker down. I'll repost. I'll repost where you're being. You can focus on talking.
Thank you. And so we run workshops for 3 months ahead of time to sort of build vocabulary in the community, and to get people to decide whether they want to do this or not. So there's a bunch of work in that segment, and then we do a sort of 1 minute pitch for everyone now. That's new. We didn't used to do the 1 minute pitch. So we used to do just read the Gust profile and then select the 24 quarterfinalists. We decided that it's good to get the 1 minute pitch in and get people to get a sense of the teams. And so we do 1 minute pitches and then we select. We do 3 minute pitches, then we select. Then we do 10 minute pitches and then select. And that gets us from 50 plus down to 6. And then we form due diligence teams of like 4 people per team, and then go through the 6 finalists and try to decide whether there's a there or not. And typically 4 out of the 6 pass due diligence, and then the argument is which of the 4 is the right one to invest in. And it's really an interactive program. But when we select you out and you're not moving forward, we then schedule a one-on-one meeting with one of the organizers to go through all of the Gust profiles. And one of the things we do is in the response area in Gust is we write down, what's going on. There's a feature request in there because it's not a big enough square to put all the things we put into it. But what we're trying to do is to get all of the investors to write a note about every company they think about and say, this company is doing X, therefore Y, right? This is a company without a team, therefore they're not ready. This is a company with no revenue or no marketing person or whatever, and so I'm not interested. Or this person has a very insightful view on this particular problem, has experienced it personally, is passionate about it, and has formed a really interesting team. I gotta know more about what they're doing, right? And so we get these positive and negative things, and we cook that into an hour of feedback. So all of those companies get an hour of feedback. Usually, what I used to do was just go through everything. And it turns out that they can't hear everything. And so what we tried to cook it down to is, what are the 3 things that if you did these things, you'd get further the next time you came through? And since we're aiming in the group, our point is not to do an investment. And then an investment is a side effect of what we do. Our point is to produce new angel investors who before didn't invest and who now do invest. And so we're an angel pump in the ecosystem, making new angels as we go along. And so we try to have 20 people who've never written a check before write their first check, which means that the people in our group are always different each cycle. So it's not a problem for people to keep coming back in, and it's not unusual that companies have come in, didn't make it to the quarterfinals, came in, made it to the quarterfinals, came in, and stepped their way through, and 4 times through, they finally get to the winner's circle. And in fact, SAC number 5 did that, and they're still going, right? They're a multi-million-dollar valuation in their last round and moving forward, right? So we've had that happen, I think, 3 times now. So it's entirely reasonable for people to come back in and use the feedback to tune up their thing and get ready. But usually they say, I have an idea, I don't have the resources, therefore I need money from somebody else. And they didn't do their market research. So in the 4 Steps to Epiphany from Stephen Blank, right, 2003, a book everybody should understand. You shouldn't read it because it's a terribly dense book. But the important part is there's 4 steps that you ought to be thinking about: discovery, validation, creation, and scale, which is before you build the product, right? So in my mind, step 3.5 is when you build your MVP and then try to aim for product market fit. But nonetheless, if you think about that in the context of the lean canvas that Ash Moria does, we're talking about the 2 top corners. Who's the customer and what's their problem, and what do they currently do, and what are the early adopters wanting that they don't have, right? And so you got to get product, problem, customer, fit. And I've started making that very concrete now. When I do my workshops, I say, where's your list of 100 people that are early adopters, that spent money with you, who have the same problem, right? That you have their LinkedIn, you're connected to them on LinkedIn, and they're knocking on your door saying, why isn't this done yet? That 100 people is a business. Regardless, I don't know whether it's a scalable business, but it's a business because there's enough hotness in that market, right? And I just did a pitch evaluation yesterday, and they said, oh my goodness, we talked to a lot of people. We talked to 10 people, and not a single one of the 10 people were in the same sub demographic, right? There was like no theory about who my submarket is, right? And they thought that was a lot of calls. And I'm thinking, in order to get to 100 people that are committed to the problem, we're talking 1,000 to 2,000 calls. But we do startup weekends where we do 250 customer contacts in a weekend. Right. So you take your team and you just focus for 2 weeks, you can do 1,000 customer contacts and get the soft, mushy version of that list of 100 if you have a there. But most people don't know who the people are.
There's actually a really good decision or kind of an industry matrix out there that I'll try to maybe dig up, and it's who is your target market? If you're selling to billionaires, you don't need to sell to 1,000 billionaires, in order to actually make a good amount, assuming that if you're selling to billionaires, your product is extremely high revenue. But I think what most people feel is the order of magnitude, anything consumer oriented, anything even business oriented, small business oriented, specialist oriented, even selling to dentists or something like that. The amount of validation that you can do up front, you're usually talking to hundreds, if not sometimes trying to talk to thousands of people if you're anywhere near a consumer level product. And I think most people, like you said, 10 phone calls with somebody who seems to relate seems like, oh man, I spent a lot of time. That's, maybe 5 hours of my time. And it's like, that is 5% of possibly what you might be needing to do.
Well, and we, and at least in our culture, we seem to be quite happy to say nice things to people we don't know. And so 98% of those people that said, gee, that's a really great idea, I would buy that, are cheerleaders. And they want you to be happy and successful, but they don't really care about your product, and they're not actually customers. And so filtering out who's actually a customer is something that I press on too. But nonetheless, most people coming into our program haven't done this work. And then they get that kind of feedback when look, this half, all of them have traction in a way that we can measure. And not only do they have traction, that is that they have some engagement. They have evidence of exponentiality. They have week over week percentage growth. There's 3%, 5% week over week growth in their engagement is like, oh my goodness, that's very interesting, right? And what they're trying to do is solve their problem, not solve the investor's problem. And so they tell us about why their product is so cool because they spend a lot of time on it, not talking to customers. They don't know what features are important or not. And then they engage in the, I need more money so I can finish building this thing. And what I hear as an investor is, I have a really cool toy that I'm building in my garage, and I would like you to pay me so I can work harder on my toy, which is not what they want me to hear, but that's what ends up coming out in the conversation, right? And so
Excellent.
when you're selling your product, you talk about the product to the customer and how it creates benefit for the customer. When you're selling a piece of your business, then you tell the consumer of that business the business story and why investing in that business is good for them and what the benefit for the investor is going to be, right? Hopefully, in this current modern world, that's not only financial benefit, but it's also impact of some kind on the world to make it a better place. But nonetheless, that conversation is about the benefit to the investor, not the needs of the company, except that by solving the needs of the company, you de-risk the company. And in de-risking the company, you create value for the investor because the valuation of the company goes higher. Not, I have a pile of things to do, I need more resources to do those things, and the value of my company stays the same through that. I just do what I was supposed to do. That's not an investable company for people.
I think that's a huge thing that we see frequently is because they're interrelated, like you say. Business success should result in investor success, but investor success, to me, it's like a different lens on the company's activities where they are looking for an ROI. There are investors out there who are not professional investors. They don't have a portfolio of bets across many private companies, and they might be convinced to give a little bit of money to something that's like a passion project or an area that they care about. But the vast majority of the capital flowing into private companies is from professional investors who are not thinking about this as purely like, this seems like an idea that should happen. They're thinking about, I need to invest in 60 companies over the next decade because I know most are going to fail. Startups generally have a very high failure rate. So it's the real Moneyball approach for most of these investors. It's Moneyball no matter how crazy you are, whether you're a West Coast unicorn hunting investor, which is like you're going after billionaire exits, or you're a Midwest or an East Coast a couple $100 million exit is still a very big thing for you in terms of rebalancing your portfolio, but still a good chunk of your portfolio is likely going to return nothing or basically break even in some
Right.
cases. I got a couple questions I want to get to on some of these
Right. So
topics that were coming out.
So let's characterize that for a second, because I think there's a much wider range of possible good angel investments than people usually talk about, mostly because of the whirlwind in the Bay Area, which talks about a very narrow set of investments criteria. It's entirely possible to do a one and done angel investment where you give them money and they get to be a 10 to $20 million company, and that company is a perfectly good angel investment, right? There's no VCs to deal with. I got enough of the company that when they buy me out of their revenue, that I'm quite happy. I got a 3x multiple. So in after I've done really good due diligence and I've eliminated the company where I see the big hairy hole in the heart kind of thing that's going to kill the company, and I'm only dealing with the ones that I believe are capable of achieving what they said they were going to do in some bounded assumption, then 30% of them will return zero, 30% of them will return less than you put in. So 60% failure, not an investment, it was a donation to somebody's cause. And then 30% of them will give me 3x return after 10 years. And then one of them will give me 10%, will give me the 10x or 20x return, right? So 70–80% of our money comes from that one, which is why we need to build portfolios of 20 companies, which is why we have to be in breadth, right? But the deal terms that you sign make a difference on which kinds of companies you can invest in. So investing in that Midwest company that's about to be a $10 million company with lovely 70% margins, that's a really great angel investment that nobody in the Bay Area wants. But why would you not want that, right? They can buy you out in 3 years at a 3x multiple, and you get your IRR of 75%. It's a great angel investment, and there will never be a venture capitalist that touches it.
Yeah, some of the terminology we're using. So a unicorn I put in the chat is a company worth a billion or more dollars. These are like the big household names like, oh, Uber. If you invested X in Uber when you were even in their third round of VC, you would have made stupid amounts of money, and therefore you can invest in 30 other companies that just like donate to 30 other companies and you're still good. A term that I've heard that our founder likes to use is gazelle hunting, which is I'm not going after the unicorn. Most unicorns don't exist. Like the chances of me finding a unicorn, how many car sharing apps were there, ride sharing apps were there, how many photo sharing iPhone apps were there around Instagram? Like hundreds, possibly even thousands, people trying it. Why did Instagram succeed? A whole lot of luck, a whole lot of connections, a whole lot of weird stuff that's really, really, really hard to predict. So rather than try to find the mythical unicorn, all I need to do is bag 3 gazelles, and I'm actually in a similar place in terms of overall return. Like a 3x return, as long as I'm not bleeding like crazy on chasing after these moonshots, is a very viable investment strategy.
Right.
We got some customer questions, some early stuff that I want to jump into. Um, Going all the way back, Suparna actually asked, and I wanted a little bit more about the startup experience because I think you kind of answered this, but he's asking, they're looking for early adopters rather than funding. Does Seattle Angel Conference help with that kind of stuff beyond the education that you just shared?
Um, our main goal is to create the new angels, and so we're really sort of tied into that funding process. I think the place that we're helpful is in the earlier stuff, in the Seattle Startups Open Coffee, in the workshops that we do, in the startup weekends, in the Lean Startup. We talk about how you do customer interviews and how you structure your experiments and all of that block and tackling on customer development as in a workshop kind of way rather than an event sort of way. I think the work that Ash Moria has done with his Lean Canvas is really useful. I think that if you look at the 16 things that an angel really wants on their system, that 12 of them are in the Lean Canvas. And so I think there's work to be done there. But if you just start with customer problem fit, understanding who's a customer, qualifying them as a customer before you believe them. And so cheerleaders versus customers is an important early test. I believe that in the beginning is a narrative process. And so if you do a Tom's Hardware kind of thing where you talk about all of the competitors in the market and what works and what doesn't work about all the competitors and build a podcast or a Zoom call or some kind of channel to reach your people who care about that problem and all the existing alternatives that they have, that's what you want to do. You call people up and you say, do you have this problem? And they say, yes. And then you say, well, what do you do about it? And they say, well, I use this and it works really great for that, but it doesn't work at all for this. And I have this happen about 10% of the time. And it's really painful because I have to do this thing by hand or whatever the thing that's the problem. As you build that very detailed competitive matrix of all of the things that people currently do, including nothing, and then taking what the consequences of that nothing are and what the cost to them of that problem is, and then identifying how you can change the cost factor by doing something different than everybody else does, that gets you to the core of the Lean Canvas. What's your lean value proposition at the center of the Lean Canvas? So if you can't get to lean unique value proposition without knowing what everybody else is doing. Otherwise, you don't know if it's unique. And so that work of a content strategy with clarity on the submarket and a narrative that's opinionated, gets you to the point where you can find your early adopters to interview and then distinguish the early adopter cheerleaders from the early adopter customers.
Awesome. And I think specifically highlight, and we'll send out some resources after this for John exists in a very interconnected world where the angel conference model, is kind of growing investors and founders already, but it also has like a ton of support programs for people. And I believe you actually do sort of channel people toward the right thing. Like if somebody applies for an angel conference and it's like, hey, you're way too early, you should go to this workshop instead. So
Yeah.
it's kind of a virtuous network. And again, that holistic approach where it's like something that we try to build software around, but we're never going to be far ahead enough is just that like the answer is never quit. The answer is maybe this isn't what you need right now, but there's another step that you can take to move your business forward. So it's no, you don't need funding or you don't need to go and pitch in front of angels right now. You need to use a lean canvas to really figure out what your core innovation is. No, you don't need to, build for 3 months or pay a tech consultancy to build your MVP. You need to validate your idea. And there's a ton of like a constellation, I think, of programs both tied in with virtuous ends in terms of increasing angel investors, public-private partnerships. I know a lot of these things are tied in with their local cities, and it's all pretty cool. All right,
Yeah.
something that did come up. Oh, did you have something to add to that, John?
Well, we do a YouTube channel, and so maybe I should try to find that and get that posted. And we record a bunch of things. One of the recent workshops we did was, building your business model based on milestones. And so, if you, the startup journey is about de-risking your business. And I will say that before product market fit, you are a startup. And after product market fit, you are a company, a business, and maybe you're a growth business and maybe you're not a growth business. But at product market fit, you found an audience that likes your product. You know who your audience is, you know what your product is, and you're selling and you're moving forward, right? But along the way, there's a bunch of risks. And when I take out a risk, then the value of the company goes up. And every time I take out a risk or reduce a risk, I make some progress on the value of the company. That risk reduction is work on the greatest risk first. So is it more likely that your team can't play nice or that the market doesn't care? Is it more likely that your idea is big enough for two people and that's the total market size? Or is it more likely that you're not going to have the financing to carry this out for another 3 months, right? Work on the thing that is the biggest risk to you right now. When you get that risk lower than other things, then work on the other things, right? But always focus on the thing that's the greatest risk. Most often, the thing that kills a company is team dynamics. People are not committed to the common process, common goal. The next thing that's most likely to kill you is market dynamics, that you just don't have a market that cares about you, right? And so if you solve those two things, having a culture of a team that's functional and having a market test that gives you real life feedback from real life customers, about eight, you can reduce the risk by a factor of 8 if you do that, in my simplistic way of thinking about the world.
Yeah, I will say both anecdotally, and I'm sure there's data and study that the craziest thing about the startup world is like the survivorship bias and the data on the death of companies is not there. You get all this thing about like success, you get rates, you get team composition and things like that. But some people's startups never even file a register thing, but they die because of team dynamics. Some startups have an LLC that's a local business thing. It never gets off the ground. They spend 50K with a tech consultancy to try to build a thing because they have an idea, and then they go away and you never hear about them again. One of the cool things we've done, not to address team dynamics entirely, but I'll put it in the chat as well. We have a tool that actually interviews the co-founders about what they're bringing to the table. It's to help them figure out their equity split allocation. But the more important thing is less about the numbers and more about the conversation, where it's like if you're really considering all the skills and dimensions of value creation that need to go into a startup in the early days, a lot of people, depending on their background, just don't consider it. A lot of times I'm an engineer by trade, so I know engineers are sometimes very self-important individuals because they're like, hey, if we don't build it, it doesn't exist, therefore we're essential. However, engineering skill is a commodity. You can go and pay for an engineer to build stuff in most cases. So really pulling out the ideas like who's putting up their own money, who's working on this full time, who's absolutely essential to the pitch and the fundraising, who's absolutely essential to the domain experience. There's a whole myriad of things that not everybody thinks of if they're just coming back from a product background, or if they're just a business development person or something like that.
Right. So Dave Parker wrote a book called Trajectory Startups, which goes through some really important thing, and he calls this the critical founder conversation that needs to happen. And you're trying to put some software in the way to make that a little bit faster
I
and
like to say
earlier.
not in the way, to facilitate it.
Yeah, but that book is a really good book. It has some really fundamental stuff in it, including the consequences of your choice of revenue model to your valuation, which I think is an under-discovered conversation. And so those kinds of conversations are really important for founders to have, right? How we structure the relationship with the customers, how we structure our revenue, how we structure our relationship with ourselves, how we structure our relationship with the angel investors is really important. And engineers in particular generally don't use that relationship word. And so it's a relatively complex conversation. And so it takes a little while, right? So one of the things that early founders probably should be doing, we're going to give you some money because we believe in you. That means we have to trust you at some level. So the most important commodity in the angel investing conversation is trust. And when you do anything that blows up trust, even if you feel a little bit skanky along the way, just a little bit, bang, the conversation's over, right? And we're going to be nice and polite, and then we're not going to call you back. And so building that relationship so that when things get weird, that everybody stays in relationship is really important. So maybe what you should be doing instead of asking for money is asking for advice from key people that can give you perspective and help along the way, so that when you get ready enough, that they've tuned you up so that you're actually in the right place to do the right job at the right time. And as you go through the stages of the company, the tuning changes, right? So it's not the same person or the same result as you go through each level of funding, or I like to think about productivity of a company, which is revenue divided by employees, right? How much revenue per employee are you getting, right? And as you get more employees, you hope that the productivity is going up, not that it's staying the same, right? You want to create some kind of economy of scale because you're making a bigger company. And if you're not getting that economy of scale, then this thing doesn't have the scalability we think it's going to do.
Right. If you constantly have to just add new bodies to a system to linearly scale revenue, there is a point where there are no margins or unless your margins are off the charts, maybe that's great. But generally, if it's linear,
it tunes out, and eventually you're a commodity, and the commodities fail. And angel investors typically can't afford to invest in commodities.
Yep. We got some investor side questions. I'm looking at all the questions. I know I'm trying to stitch them together in a cohesive narrative. So if I haven't got to yet, don't worry, I will. I want to get just some table stakes questions out there because some of these terms are new to people. One, what is Series A, B, and C? I think this is a fun one to wander into.
So I say now that Seattle Angel Conference is investing in pre-seed, and what we mean by those, people used to say that it was a certain amount of money, but now we're seeing seed rounds of 10, 20 million, which is just breaking my brain. I can't quite swallow that. But just let's think about it as the series of the order of when you take a round, right? So when you're taking early friends and family money, they're investing in you. We call that the FFF, right?
Friends, family, and fools.
Friends, family, and fans.
Oh, fans.
And so that's typically personal, very personal, right? It's about the team and the people, maybe not even the idea. And the first outside money of people unrelated to you is a pre-seed, essentially, where you're just trying to get some of the core things nailed down. We still expect in this day and age of the internet, with that 5.2 billion people one phone call away from you, that you ought to be able to do some customer development ahead of time before you build the product. In fact, I think you can get traction with people with your marketing before you build your MVP, and you can get sales before you build your MVP, which makes the engineers all cringe. But it's really important to understand that your market risk typically outweighs your execution risk by maybe an order of magnitude. So the CB Insights document interviewed 115, I think, startups that got angel investing that failed. And they said that 42% of them failed because of no market need, right? Which is to say they couldn't sell it, right?
Yeah.
And so why build it if you can't sell it? So, and why build it if the thing that you're building is not what the customer is willing to pay for? And so frequently there's like a 9-month, you get the MVP set up, you get this popcorny engagement with a bunch of people who then give you a lot of feedback, which then tell you all of the features you built that they don't need, and all of the features that you built that are in the way of them using the one feature they do care about. And you take 9 to 12 months to rebuild the MVP so it finally meets the needs of what a customer base needs. In the meantime, you're struggling because you have no positive cash flow. And so if you invert those and you figure out what people need and find out what they're willing to pay for, and you build little tiny things that do that, and then grow that to flow and cash flow. So I beat the drum of your most important thing, your goal of a whole team at a startup is to get from idea to cash flow positive as fast as you possibly can. And it's much better to come to an angel group and say, we're cash flow positive. We've got percentage and over week growth in our revenue, and we see these fixed cost problems that are going to get in our way and are going to stall us out. And our problem is we got 1,000 people back there that are in our way, and if we just got a little bit of money, we would be able to address those 1,000 people in a way that improves our productivity per employee by a factor of 4, right? Like, what angel wouldn't want to be involved in that, right? And so that story is a great one to set yourself up for, as opposed to the I'm in the garage trying to build a product so that somebody will helicopter in and save me later, right? That fundamentally different stories, may be exactly the same amount of work, right? In fact, I would argue that doing your customer development first is going to actually reduce the overall work of the whole system, because you'll build a lot of things that you need and a lot less things you don't need. And you'll be speaking to customers in the language that they use because you listen to them. And so you'll be very focused.
Oh, I don't know if I'm
On
lost
your
or, oh, there we go.
sub-market hire that you want to talk to, and therefore your conversion will, there you are. Your conversion rate is going to be so much higher, so your efficiency of your business is going to be higher, and you will be more able to predict your cost of customer acquisition. And the magic is when you can predict your cost of customer acquisition, you are now at product market fit. And so if you can't get to cost of acquisition being bounded, you are still not a business.
Yeah. One minor technicality. Could you move your microphone a little bit closer? Some people I think there's a disparity between you and.
Oh, I think it's this one right there. That's the problem. Let me see if I can change my audio. Let's see here.
And while you're looking into that, I'll add a little bit to the customer acquisition. If you ever use Google Ads, they will tell you a CAC, but that does not mean that
It's
is
a
your
lie.
customer.
Yeah.
Yeah. There we go. Oh, you sound much better.
All right. Yeah. This one was working instead of that one.
Yeah.
See, that's what happens when you boot up a new machine that you've never configured before.
Yeah, I really threw John a curveball here by giving him a crusty old GoToWebinar to join in, and he was on a Linux machine, which is basically a death trap. But fortunately, the Windows machine sounds like it's working out. And I learned today that the chat does not work in GoToWebinar for attendees. Therefore, we will probably be moving off GoToWebinar. Hopefully, they're scanning the audio and they will use that as product feedback. But yes, all right, cool. We have some other questions in here. So we just covered the series A, B, and C related to that.
Let me finish that for a second.
Oh, sure.
So Series A is the first institutional money, right? So that's all of the venture capitalists. And the venture capitalists are, I have limited partners and they put in money, and I have general partners and they decide where the money goes, and they have a thesis and they invest in a particular strategy. angel investors and family offices are particularly idiosyncratic about what they care about. And so in the angel conference, our goal is to get the investors to understand their thesis about what they care about and what they don't care about, so they can spend less time with the companies they don't care about and more time with the ones they do care about and focus that. But pre-seed and seed, we'll say, are early angels coming in, and then Series A, Series B, Series C, D, E, F, and G, it keeps going, are just, I get to the next level, next round of institutional money, and then I move from venture capitalists into private equity, and I move into banks, and further on it becomes more and more like a bank, and early on it becomes more like an angel, right? And so typically a pre-seed is going to be 200 to 500K round. You're probably going to raise that from more than one angel. Typically a seed is going to be in the, I don't know, 500K to 1.5 million, right, round. But the Bay Area has distorted that dramatically. And we have seen in the Halo report, which is a report about how angels invest, that the same size company can be like a $1.5 million company in Boise, and it's like a $3.4 million company in Seattle, and it's like a $9 million company in the Bay Area. Same number of people, same product. So what's the difference? Well, they're fundamentally different markets. And in fact, tomorrow we're going to do a workshop on the consequences of chasing a higher valuation as a pre-seed company, because in the beginning, you have no revenue. Therefore, there's no reference point to your value, which is why we do a convertible note, is because there's no reference for the value. So we have to argue too hard about the price. But at a point where you start getting predictability on your customer acquisition costs, you also have predictability on your revenue, which means that all of the MBA equations all fall into place. And so now the valuation is not a function of belief of the investors, it's a function of the revenue of the company. And the more you do that, the more you get tied to facts, the less likely it is that the next round can be an up round, because you have to have the growth in the revenue to make everything go. It turns out that getting more and more, getting 3% growth in revenue every week actually gets harder and harder and harder.
Oh yeah,
And
the base
so,
is growing. 3%
so
6 weeks
it's
from now is very different than
right.
it was.
And so you have
Yeah.
to fundamentally change your engines, and you have to, and that takes fixed costs amounts of money to change this engine from that way to this way. And so the typical Series A venture capitalist wants you as a startup to triple, triple, double, 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 right? I give you the Series A money. The next year you triple your revenue. The next year after that you triple your revenue again. So you have a $10 million valuation with a 5 million or 3 million revenue. And so I have 3 million, and then it becomes 9 million, and then 9 million becomes 18 million. And then I double that. And so now I'm, 36 million, right? And that's going to happen in a 3-year period, right? So if I can't achieve that because the engine that I've built doesn't produce the revenue that they're expecting, then I get a down round, and all of the investors get unhappy because the returns just went away.
Yep. And it's also down rounds trigger a bunch of things in some of the fundraising documents that you've previously signed. They're generally something every company tries to avoid unless, yeah.
With nasty, ugly teeth, yes,
Yeah.
right.
Awesome. So we have some general stuff. Kyle, you've been here like the first question, and I'm finally getting to it. You're talking in and around some of it, but when you've mentioned due diligence a couple times, and some of these concepts are part of due diligence, but just generally, what sorts of things do you as an investor look at and for during due diligence? And what is due diligence in general, just for everybody?
Well, due diligence, all of the companies told us a bunch of stuff, and we're doing the Ronald Reagan thing, trust but verify. We're trying to see if what you said is actually what is. And so you said that there was a market. Let's go see if there's a market. You said you had a team that was functional. Let's go see if the team is functional. You said that you were able to produce this thing with certain level of efficiency. how's that going? What's your error rate? What's your delivery rate? How many customers are you calling? Just touch everything, right? Look at the financials, look at the modeling, look at the financial discipline. That's one of the top 7 risks, I think, for a startup is just plain financial discipline. Um, look at the team dynamics and make sure that you've got the right set of skills in the team. 5 engineers and 1 sales guy is probably not the right mix of employees. Um, I would argue that marketing and sales is as big a problem as the development. So for every engineer that you have, there's probably a sales or marketing person in there somewhere, and maybe more at certain stages, and that confuses people in early startups a little bit. So for the Seattle Angel Conference, what we ask the teams to do is a 360-degree review of the company and push the company to the edges to tell us where the risks are, right? So when I ask the founder a question and they go, oh, I hadn't thought of that before, then you would like them to think about the risk and then come up with a plan, right? Did you know that there are these 5 other guys over there doing something that sounds awfully lot like you? Or did you know that there were these 3 guys that did exactly this business and they're now, just took a $10 million round, and I can't tell the difference between what you're doing and what they're doing. So tell me again about your competitive matrix, and you would like them to evolve, right? So from the Angel Conference, we're pushing to the edges, which means that our due diligence is a little bit stronger in the sense that we touch a lot of things that a lot of angel groups won't, because most angel groups are looking to get to know. And
Yep.
so as soon as they get to a no, then they stop, right? And thanks very much. That's also why they don't give you very good feedback, is because they got to know and they stopped listening. And so you would like, in the early stages at least, to go to places where you can get 360-degree reviews of what you're doing. And there are some angel groups that do a good job of that. There are a lot that don't. And so having a good angel advisor who understands how to do the review is important. So what do we care about? Well, Techstars says team, 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 market, traction, idea, right? So what do we mean by team? We mean they have the right skills in the team, that the team knows how to work together on things, that they have a work process, like your software engineers are using GitHub or some mechanism to manage their source code, that you own the source code, right? And it's not sitting in some dev shop in the Ukraine. There's just basic process things about the business, that you have a bank account, that you're a legal entity, that all of the things inside the financial modeling sort of makes sense in context. So we're going to look for a 5-year projection about where you think you're taking the company. There's a really great talk in our YouTube channel by Tristan Cromer about fuzzy business modeling that I think I've not heard a better talk about how to get to a startup financial model than that. So we touch all of those things, right? And David Rose, the founder of Gust, also has a book called The Startup Checklist, which is sort of like a step above where we're at, because the younger the company, the less things you can actually verify, and the more you get older, the better the ability to predict the answers to some of the questions. So doing a Series A due diligence is not the same as doing a pre-seed due diligence. We're not trying to test every contract that you've got, but we would like that you have employee agreements for all your employees. And we'd
IP
like to
assignments, proper stock grants with vesting, a
basic,
cap table that makes sense and actually has documents that back it up.
yeah, all that basic stuff. And that's another reason why platforms are useful, is that they can put that all lined up in a way that it's easy to see.
Yeah, one of our Gust founding mantras is the happy problem to have is when somebody is actually interested in giving you a check, but then they look under the covers of what your corporate history is, and it turns out that you never actually have an advisor agreement for that person you claimed was an advisor. Ooh, that might be a trust flag, or that might be, oh, we have to rush and get that signed. And if you're going to a traditional angel group, those are tons of reasons for them to say no. If you say a bunch of things, they kind of like you, they think the market's cool, you have a good idea, but then they look at they ask for diligence, and what they get back is like, I have an LLC in Wyoming, and I'm going to I'll get that guy to sign that contract, or we'll add vesting schedules to our stock. It can really slow things down or lead pretty much straight to no.
Right.
Uh,
And when you make it hard for people to give you a check, then the answer quickly becomes no. I'm
yeah.
done. Right.
And this is something if it's not obvious, I really like about the angel conference model is because it's that learning by doing approach, both on the investor side and the founder side. It is that there's far less opacity in the space. Literally, most angel groups, like John said, you just won't even hear from. You won't even get a no. You'll just throw an application into the ether and just never get a phone call back.
Right.
But I think that conference model of really building up on both sides and it's kind of cool to learn together, right? If you're not an angel investor, but you want to be one and you meet a person on a Zoom call and then 3 months later, they're still showing up to Zoom calls to learn about topics together, the chances of like you building your network and building meaningful relationships and seeing somebody like grow professionally, interpersonally is a lens that most like single application investors never even get to see. Right. It's most angel groups do not take repeat applications for the same companies unless they've done a round in between. But it's a really cool model.
And so if you're a 10x company where you're growing 3 to 5% week over week, then there should be fundamental changes in your business over 3 months. We should see revenue changing. We should see customers complaining. There should be a bubbling of stuff happening, right? And if you're telling us the same story at the beginning of the workshops as you tell us when the reviews start, and it's the same story when we get to the semifinals, then you're not a growth company.
Yeah. So related to kind of the flip side of the diligence conversation, what about, and I know the conference model is a bit more involved, so 2 minute pitches aren't, from the get-go, but James Burt asks, what are some of the main things an investor wants to hear about a business in a 2 minute pitch, your classic elevator pitch, have you?
Well, I think that there's 16 things that we're looking for, and that in a 3 minute pitch, you can get at least enough of a flavor of all those 16 things to make it go. And there's um, a if you search for LSS customer um, problem fit, let me see if I can get it on this computer. LSS customer problem Sechrest.
Is it a slide share?
It's a slide share, yeah. And then slide 20 of that is what we're really hoping for.
I will actually share that. Is
Can
it
you share
the
that
lots
on
of
the screen?
text?
Yeah, with the red squares with the brackets.
Yeah.
So, the Jeffrey Moore value proposition is for this kind of customer that has this kind of problem. Our company name is this kind of business that creates this unique value, right? And that kind of thing is. Can you share your screen with that?
Yep.
Can you
Oh,
get
hang
to
on,
slide
all my notes.
20 so everybody can see it?
Yep, I'm getting there. I just have to grab this. All right. You should be able to see the slide share now, right?
Yeah, it looks like a little tiny fuzzy red black thing.
Yep, I'm
But if,
going to.
but if I click on it, then it gets bigger, right?
Yeah, it should. We should move to the top.
Yeah, so if I hit the expansion thing, for this customer category, this massive pain, this market size opportunity. So, right, who's the customer? What's their problem? Um, what's the size of their market? What's the name of the product? Da, da, da. You go through all of these things. If you don't have a 5 to 7 word answer for each of these things, then you have some more working to do. And this fits in a 1 minute pitch if you practice it hard enough. But it's boring. And so a 3 minute pitch is much more interesting if you flavor it up a little bit and make it go. But this is the places where we're essentially going to end up pushing at the beginning to try and put together an idea in our mind of here's an idea, you're an Uber for laundry. Okay, I get that. And there's 15 million people in Seattle that care about this right now. And so we can do something like that. Just try and focus it a little bit. And so really start with a lean canvas and then team, market size, traction, and go to market are other things you have to really understand. And the important thing to understand about go to market is the difference between the first market that you go to fastest to get the cash flow positive and the middle market that you go to build institutional strength and margin, and then the the third market, which is and I went big, right? So those don't have to be the same market. They don't even have to be the same customer base. You just need to understand the go-to-market that threads you from one to the next, right? And so I'm doing a medical device. It's going to take me 2.5 years to get approved by the FDA, but I take my product and I put it into the veterinary medicine in the United States, or I take it to Africa where they don't have an FDA, and I run it in a way that I get cash flow positive in the vet market. And then I take that medical device and I tune it for people and run the tests and validate it for FDA. That can be a very good way to do a go to market where you get cash flow positive first and get big later, right?
You have a hard stop at 2 or
No,
in 3 minutes. Oh, you do not? All right. I'd like to get through some more of these questions, but I don't. I want to be respectful of your time. And I promised
I'm
somebody I'd
good.
get. What's? Oh,
My
you're good.
my 11 o'clock moved to 2, so we're good.
Great. Because so there's some quick questions just based on the program. Is this South or Northwest only for
Uh,
Seattle Angel Conference?
it started out Northwest only because we were trying to, 94% of angels were investing within an hour of home. And so when we hit COVID and we went virtual, it didn't make sense to stay local. And so now it's North America wide. And we're curious about Europe. And so we're going to do a transatlantic one and see if we can figure that out. So um, perfectly good companies in Europe at the moment just don't understand what it takes to invest in them well. So we'll try and learn that, but that's a separate program, right? So for SAC 21, the deadline is February 24th on Gust. So then we will collect hopefully 50, 60 companies, and then those companies will get reviewed. We have, I think, 37 investors at this point. So there's, everything's coming together as it should. We'll start March 1st with the introduction to Gust for the investors, and then on March 8th we'll do the 1-minute pitches. And Mexico and Canada are part of North America, so we're
Oh,
good.
excellent. Yeah, I posted the link to that application again, and like John said, February 24th is the founder deadline for there. We will send out some more detailed information about that later this week as well, and probably closer to the deadline. Some other relevant questions. There's a bunch of questions that are specific to somebody's business that I'm going to save a little bit to the end so that the people who only had an hour blocked can learn mostly about the general topic. Back to the friends and family and angel rounds. Francisco asks, like, what percentage of equity is recommended to give away?
Well, um,
Little as
there's a
possible.
there's a really good diagram how angel funding is supposed to work, and basically you want to look at the consequences of the investment each cycle, right? So we as angels would like to have as much as reasonable as we can get for the price, because then that gives us a higher return. But we recognize that by the time you go through 3 or 4 rounds of funding, that we want the founders to be winning too. We want them to keep paying attention all the way to the end. And so we don't want the founders to end up with, no reason to stick around and pay attention. And so typically I would say a full round is around 10%. That would be nice. Some venture capitalists are looking, they'd really rather have 20, but they don't want 50. And if your lawyer has 40%, that's really a bad answer. We have not invested in companies because the lawyer that formed the company had 40% of the stock.
Wow.
Yeah, it's just like, no. And so you don't want people to have stock that are not active in the business. The point of the stock is that people are contributing to the success of the business. So if you have a co-founder that you had a fight with, then this is where you needed to have that vesting conversation and bought all of their stock back. And I actually learned that the hard way, right? I had a co-founder that basically we had a disagreement and he went away, and at the end I sold the company for more than I put into it, and then I had to go give him a multi-digit check,
That
which I
hurts.
did not enjoy giving him that check. um, so I think the percentage of the company and the price of the stock are interrelated for the investor. you know that we're going to write a certain size check because that's what our capacity is to write. And so you would like to find an angel where the size of your round and the size of their check are compatible with each other. Although this notion of using SPV, special purpose vehicles, to gather a bunch of people at a lower level, like we write $5,000 checks, form an SPV that writes a $200,000 check into the company, but all of our investors are writing $5,000 checks, which means, from an investor point of view, I'm investing 10% of my net worth. Maybe I'm investing less, but probably not more. Um, and then I need to put that in at least 20, maybe 40 deals. So I need to be writing like $5,000 checks, not $25,000 checks. And so in order to be effective for the startup, we need to gather a bunch of those people in one entity, and the SPVs allow us to do that. And so you might be able to find those kinds of groups more and more now that AngelList and Assure are making it easy to create the SPVs. There's probably 5 or 6 different entities that will make the SPV for you. And there's actually a new thing I just saw a week ago called syndicate.io that lets you do an investment on a DAO. So you can be all crypto and do investment. But nonetheless, I think the notion of managing your capital stack so that at each round, the percentage of ownership by the founders, the percentage ownership by the company key employees, and the percentage of investor ownership is rational. And you should plan that out, right? This is how
Yeah,
much we're going to give to investors. And this turns out to be the choice of the founder. The founder gets to choose what SEC exemption they use, and therefore what kinds of company or what kinds of investors they take on. The founder gets to choose the amount of the stock that they sell, and then the price of that stock then becomes negotiable, right? And the value of the company is a function of the belief of the investor in that price making them money, right? So you make the price of your company too high, and then our ability to make a return goes down and we become less interested. You make the price of the company too low, and then the resources available to do what you need to do are troublesome, and then you have to go ask for money when you really shouldn't have had to go ask for more money, because that takes too much energy on your part to get the funding round. Raising $100,000, raising $1 million, it's about the same amount of work, right?
yeah. I think that harmonizes with your previous point in terms of don't raise too much money. If one, it means you're giving away tons of your company. If you need $300,000 to hit your next milestones, and you could convince people to give you 600,000, but you're selling twice as much of your company, that's not usually a good exchange. Really being one, to communicate to the investors, and to answer a question here that was in the chat too. If you're trying to get investments from multiple angels, do you put in the pitch deck just what you want from them, or do you put the whole round in there? You
Whole
you usually
round.
you put the whole round, because they're all going to be told the same story, and you want to know exactly how you're going to deploy that capital, how much you need, what percentage of the company you're going to raise it for,
And
etc.
it's really horrible if you try to give different angels different deals, because the SEC will start believing that those should have all been the same deal, and they'll all mush them all together. And so the multiple little tiny baby rounds weren't actually baby rounds, and you didn't do your SEC work, and then you got to go talk to your lawyer about the SEC, and that's a pain. You don't want to do that.
Yeah, generally exemption filing it's something a lot of founders miss. And again, this is a survivorship bias. Like the amount of founders who probably miss their exemption filing probably also missed a bunch of other stuff too. But when you sell securities, the SEC, if you don't have any exemption, they assume that you should register them. And registering a security is basically going through an IPO. No startup has the time or the money to navigate all the filings and auditing and stuff it takes to actually IPO a near valueless business, right? Or a very, very small value business. But instead, the SEC makes all these exemptions where it's like, hey, if you sell securities and you limit it to this kind of sale, you're good. You get what's called like a safe harbor, so you don't have to register them. I put some in the list, and I will comb out the SEC website. They actually have a pretty helpful website, and they recently updated it. If you check your last Gust newsletter, or the ones that's going to go out tomorrow, will actually link to their building blocks thing. But it determines who you're raising from, if they're accredited or not. The most common one is still 506. Am I going to use the right one?
Mm.
506B. which allows you to raise unlimited money from accredited investors as long as you don't generally solicit, which is you're not throwing up billboards, you're not advertising the terms of your deals. That's been far and away the common exemption. Stick with accrediteds. Don't, you file a Form D that roughly says how much you're going to raise over a period of time. Maybe you update it once or twice, but it's pretty simple. Outside of that, you usually want legal help. Like regulation crowdfunding rounds, you need to work with a platform or a broker dealer. Regulation A is very complicated based on accrediteds, unaccredited, and check sizes and things like that. 504, you can blend some stuff, but you got to do state by state filings for these blue sky laws. It just gets to be a mess. So if you can keep right 506B, generally you avoid a lot of headaches, but sometimes you don't have a deep pool of accredited investors. Maybe you're not in Seattle Angel Conference, so you've never met them. I would say sometimes the effort's probably worth a lot more time to expand your network of potential accredited investors and go that path rather than trying to find the finer details of how you can get around a Regulation A thing. But sometimes certain companies, certain industries, consumer oriented things, crowdfunding might be an option. Some more inventive regulation exemptions might be an option.
So Reg 504, Reg D 504 is the intrastate exemption. And in some states, they have an intrastate option to do fundraising inside the state with anyone in the state. And so the senator that put that all together long ago thinks that that's the way you're supposed to do it, that you're first
Oh,
supposed to do
interesting.
a Reg 504 and you get a
In
bunch of
one
friends of
state.
them and ones in your state with your friends, and you get them to get you big enough and strong enough so that you can do a Reg D 506B, and then you use that to do your venture stuff, right? And
Hmm.
so he has a very specific view of how that's
So that
supposed to
way
work.
you only navigate one state's blue sky laws and you're only taking investment from. That's an interesting approach that I
Yeah.
don't think holds up as much in this global world and investment from everywhere, but it's totally viable.
Well, if
And
you
it would
think about
simplify
where your
things.
network is, the chances of your network being 80% local is very high,
Yeah.
right? So it's not that unreasonable. And the Reg A is now the Reg A plus stuff, which really opens up the doors for a bunch of things. And the other thing that's opened up recently is that crowdfunding is now up to $5 million.
Yep.
And
That was a
so
big change
if
in
you,
the
if
pandemic.
you take the Reg CF stuff for $5 million and you match that with a Reg 506C thing, and you put those together, then you get the angels to do the due diligence on the crowdfunding platform like Republic or WeFunder, and then you use crowdfunding to multiply that by a factor of 2 or 3, right? Then you can, raise a relatively small angel round, which will then turn into a crowdfunding round that's a big angel round size, with a lot less effort because you're doing a B2C business and you've already built this audience of people who love the idea of you doing this thing, right? Which is back to the product development follows the customer development, right? So you get the customers who are all excited about you building it, you do the crowdfunding thing, you get them on board, and now you have your audience that's ready to pay you already, and they win when you win, right? Because they own a piece of your company. And,
Yeah.
and then that's where the revenue financing starts becoming even more interesting. But nonetheless,
Yeah. Before
that,
we jump into revenue financing. So I turned off question asking because as usual, we we have driven out tons of questions by mentioning tons of things. So I'll try to get through some of these, and we'll maybe try to wrap it up in 20 minutes. If do you
that's fine.
have enough time for that, John? Awesome,
Yeah.
thank you so much. So super related to what we were just talking about, Scott Holland asks, how does this friends and family round fall into the SEC regulation? Do I have to worry about that if I'm taking money from my uncle? Yes,
Yes,
you
you do.
do.
There is no SEC friends and family round thing, right? And so you have to use one of the exemptions, whatever that exemption is. You can do 504. You can sneak them onto the cap table because they have a role in the company. You can do a personal loan to you. There's a bunch of ways to dance around the question. The lawyer answer is you don't want to have unaccredited people on your cap table, because there's reporting and accounting requirements that come along with that. Even though Reg D 506B allows for 35 unaccredited people on your cap table, the lawyers tell you don't not do that.
Yeah, it
And
usually
so,
ends up being more expensive than it's worth to keep up with the filing requirements and the legal work.
right, but but the classic startup answer is to ignore that and do it anyway. And so then, right, there's a mess in there somewhere, right? And I think it's probably worthwhile for you to put into that conversation Rule 701, which is the how you give contractors and other folks equity instead of paying them, right? And so they also end up on the cap table. And when you're accredited, right, we haven't actually said what accredited is. Accredited is that you have a net worth of $1 million, not counting your house, or you make 200K a year, or you make 300K a year with your spouse. And so one of those three. So they just raised the minimum tech wage in Amazon to 350K a year. So like everybody who's starting as a tech job in Amazon in Seattle is accredited, right?
Right.
And none of them invest because none of them know that they're accredited. And so that's part of our goal is to wake up all of the Facebook people and all the Google people and all the Microsoft people that are accredited but don't know what that means. But people can be accredited because they are part of the C-suite of the startup, and that makes them accredited for that startup. Or they can be accredited because they're in a startup and that startup just got funded at a $4 million valuation and they own 50% of the stock, and so now they're
Kind
accredited,
of like
right?
shadow
So,
accredited.
well, no, it's
No, not
realized.
shadow,
It's
yeah, but just
it's
yeah, they have
realized
assets.
valuation, right? You had a valuation event and it counts, even though the wealth advisors don't want you to do this because the wealth advisors want to invest your money for you, and none of that valuation is money they can invest. But along the way of I'm going to try at the beginning by writing little tiny small checks, and then I'm going to grow to write big checks later as I get wealthier. It's completely reasonable, and it seems like the Bay Area is full of people who I'm a startup, I got funded, therefore I'm accredited, therefore I'm writing small checks, right? And Jason Kalkunis has a cloud of these people around him that are following what he's doing, right? And
Yeah, and the
so
syndicates model and stuff from AngelList, there's a little bit of that as well.
right. And now I believe that it's really important for an active angel investor to be doing due diligence. And you either do the due diligence or you assign due diligence to somebody else. And as soon as you've assigned due diligence to somebody else, they better be on the hook for the consequences of that. And that to me is a micro VC instead of some random guy at an angel group. So I'm not fond of people following other people in an angel group without due diligence. I think that if you're in an angel group, you should be an active investor. You should be doing your due diligence. You should understand the risks and you should communicate those risks to the other people that are coming into the same deal with you. And if you're not going to do that work as an angel investor, there's plenty of micro VCs that'll do that work for you. And then you can be passive over there, right? But don't pretend to be an active angel investor and then play a passive role. That's one of my bugaboos.
I like it. We have a couple technical questions on just Seattle Angel Conference. We have some people in Africa and some people in Canada. Is it only US-based companies that can apply to Seattle Angel Conference at the moment?
No, it's North America, so we invest in Canadian companies regularly. That's not a problem. We have not yet seen a Mexican company. We don't do outside of North America because we don't quite understand the laws yet. We're going to first try doing Europe, and then once we figure out Europe, we're going to try Africa. And so, we're trying to get to Africa. For African companies, I would suggest that they look at a company called Fledge.co, which is an accelerator for impact companies. And I would also look for a thing called VC for Africa, which is a website that has a bunch of people doing venture capital in Africa. And that's supported by the ABAN, ABAN, and the EBAN, EBAN, European Business Angel Network, and the African Business Angel Network are working together to get that going. And I think it's much more likely that you're going to get investment out of Europe for Africa than you're going to get out of the United States at the moment, right?
Yeah,
We're still
we've seen
looking for the personal relationships that make it easy for us to validate. On the other hand, I have invested in a Tanzanian company through the Fledge program. So the Fledge program is African biased and has probably 6 out of 8 of the companies in each of their rounds are African companies. So he has a company called Africa Eats, which is a holding company of a bunch of startups that are ag tech related. So there's a bunch of stuff going on there.
Yeah, and John mentioned EBON and ABON. In almost every continent or cluster of countries, there is an angel federation that are usually great resources to go and find out. Things are still pretty local, even though like people invest globally. Usually the networks get built locally. So like ABON is, I think it's the African Business Angels Network. EBON's the European Business Angels Network. There's BAE, which is Business Angels Europe. But those federations are good places to start to find other things like angel groups, accelerators, and things like that that are actively investing in the space. And they usually do some level of vetting. There is a surprising amount of fraud in not from entrepreneurs defrauding investors, but rather people pretending to be investors or legit and trying to like coax entrepreneurs into like sharing some stuff. So keep a lookout for that. Do we still have you, John? I think your video froze on me. Or maybe my video froze. Oh, we lost John. All right, we'll see. I'm gonna check my email real quick. His new laptop that he used specifically to attend this might have actually ran out, but let me see if I can address some of these additional questions while he is coming back. I think we had an early on question, is it advisable to have 100 of your customers to sign up for the prototyping phase when you actually plan starting with 3 of them at the prototyping phase? So this goes all the way back to the beginning about the idea of doing market validation. Prototyping is actually building something for somebody to play with to prove a concept. Usually the idea is you probably throw it out. It's not going to be the infrastructure that you're building on top of. So the idea of talking to hundreds of customers is not necessarily to get 100 customers using your prototype, unless the prototype can actually deliver something valuable for them or super valuable information for your business. So if you're trying to build a social network or something that relies on significant marketplace dynamics, or like the attendee account is very important, you might want your prototype to be able to support that kind of thing. But I think what John's point was leaning more towards is if you're trying to figure out if there is a market for the problem you're trying to solve, talking to hundreds of people is really the only way to get a decent signal, because like you said, one, people are people pleasers. They will often give you like nice answers if you're trying to do something, and two, you just need volume of signal. So you might survey, interview, have conversations, have people fill out a form, express interest, walk through maybe a mock-up or something like that with hundreds of people. If you're actually going to be working on the prototype and getting like some power users early on, you might do that with a smaller amount of people, again, depending on the size of your industry and the size of your market. Um, if you're going after a huge one, but if you're building something for like other businesses, it's probably going to be very noisy to try and coordinate 100 small businesses using your, whatever app in the super early stages. So you might want to select a small amount of internal champions if you're doing that kind of high level feedback. So hopefully that one's helpful. Cameron, if you're still here, because I know you were bugging me throughout, I will attempt my answer to the question of distributing one share to everybody on Earth. Is that a humanitarian expansion strategy? This is a very interesting thing that is not the first time I think I've heard of it, if I'm interpreting it right. But the idea is if you start a company and you literally just give everybody a share of your company, and as the company increases value, doesn't the entire world increase in value? Theoretically, possibly. The realities of that is, some of the stuff that we talked about here is ownership in a company, an entity. It comes with a ton of obligations, tax obligations, filing obligations, international cross-border obligations. Literally, there's certain countries from the US that you cannot do business with, so you wouldn't even be able to get that reached. The sad fact of it is the technicalities of actually doing that are incredibly time consuming, more so than probably building a business that has value and is growing. So as much as I like the spirit of it, based on even what we do, is like just getting a Delaware C Corp up and running for 3 founders has SEC filings, has IRS filings, 83B elections. You want vesting on your stock grants. There's shareholder voting requirements. There's like consent in lieu of meeting requirements. There's just a ton of stuff to actually establish ownership and keep it valid. That I just think the scale of the approach isn't there. You might want to check out DAOs and crypto stuff, which is very untested waters still at the moment. But they are trying to do something similar to that in terms of fractional ownership. So hopefully that was helpful. I think, give me 1 second as I spin a little bit and see if I can find what happened to John.
Hi, Ryan.
Oh, there you are.
Sorry about that. My
Yeah,
computer all locked up.
I
So
figured
I
it might
came
have
in
been
on
me.
my phone and I had to download the app to do that. So anyway, happy to answer some more questions while we have the chance.
Great. I actually just ran through the questions that I felt comfortable answering, um,
Okay.
and we have just maybe four left. Um, Earlier, you mentioned being cash flow positive. Justin asks, is that just for the cost of revenue or total operating expenses or something else?
Well, I think that it's a really dangerous habit to exclude like founder salaries. I think you should model what it takes for you as a founder to do nothing and to have every role in the company paid for, right? And so if you're a founder doing actual work in the company, then you should have a salary. Now, you as a founder can choose to put that money back into the company or not, but as the cash flow positive target, you would like it to be, in the words of Paul Graham, ramen profitable, which is everybody gets paid enough for them to be able to do the next month's worth of work, and they're relatively happy to do it so long as they get making progress, right? And so I mean cash flow positive, including all salaries, all expenses, everything, as though you were a real business making progress, even if the margins are less than you want, even if the salaries are less than you want, people are still able to get by. And that target point then is an inflection point. Everything after that is gravy and everything before that is pain, right? And so you want to be above that as much as you can.
Excellent. Another question is, what is the process of determining the price for your product? A little bit more startup development-y, but I'm sure you've seen this for some of the
Yeah,
companies that enter your
there's a
programs.
guy in Seattle named Mike Pritchard who runs a company called Five Circles Consulting, who runs a series of workshops called the Pricing Guru. And he has a methodology called the Van Westendorp methodology. He's got a good blog post on his website about it. And basically, you're asking people, you're interviewing people in customer development, for this product that does this thing, what price would be um, uh, too cheap? What price would be too expensive? What price would be, what would an expensive price be? And you ask four questions and it basically builds a square around your price. And then your choice then is to try to figure out where in that customer base you want to be, right? Lower price often means more customers, which may in fact mean more profit, or higher price might be fewer customers, but and you have to do the financial modeling of different price points to figure out what the right place is. But I don't think you want to go, um, all of those other people are doing something similar to us, so we'll just land in the middle of them. I think that's a great way to give away margin. And as a startup, you should not be giving away margin because you don't have enough to give away. And so I did that with my company. I did cost-based pricing instead of customer-based pricing. My competitor was $5 more a month than I was. They were 20 bucks. I was 15 bucks. We ran that way for several years. The consequence of that was when I sold my company, I left $4 million on the table that I should have put in my pocket, that I couldn't put in my pocket because all of the money that they used, that $5, I mean, their costs were
They
about
can
the
grow.
same as mine. They put it into growth and they grew faster than I did. Right? What a surprise! So yeah, don't use cost-based pricing. Use cost-based pricing for setting the floor, and then figure out what the market's willing to pay. If the market is not willing to pay your floor, there's no business, and you should
Yeah,
just stop. Right? And so you have to manage both ends of that. What's the margin-based price, and what's which the market is willing to pay, which is dependent on the sub market that you're in, because early adopters will spend more than early normal, will spend more than late normal, right? So the stage of that sub market and its readiness to engage in it will change the price. So you would expect as a startup that your price starts high and that you sell to a few people and that it migrates down as you get more and more predictable about everything, and that more predictability leads to faster and faster growth because your price is going down. because it's
And
always easier to lower your price than it is to raise your price.
yep, and hopefully your operations are improving too, so you get a handle on expenses and cost of goods sold and things like that as you scale.
Right, right.
Awesome. You mentioned a webinar tomorrow. Is that open to the public or is that something just for
Yeah,
the conference
it's
attendees?
on our meetup group. It's open to the public. Bob Crimmins is going to talk about the consequences of chasing higher valuations. We'll see how that goes. Just meetup.com/Seattle-Angel.
Awesome. I'll drop that link in the chat as well. And the last question we have is you gave an example of a medical device company. Was that just a fictitious example, or is that something that
No, it
you
was
actually had?
specific. Yeah. Um, they uh, they did a 3D printed uh, blood counting, the rate of which blood goes into somebody's arm.
Oh,
And
cool.
typically that's a, multi-thousand-dollar electronic device. And they did a 3D printed thing that you could tune that would do exactly what you needed without all of the electronics, aimed at a lower end market. And they went into, or they explored going into the vet market as a pathway into the regulated markets.
And are they still around? Is there a name for that company, or is it private?
Yes, they are. Shift Labs.
Excellent. And so that is it. Thank you so much for calling back in and saving me from my awkwardness. Um,
Yeah.
and I
Sorry,
think we,
sorry. I got to figure out what's wrong with this computer. Anyway, thanks.
yeah, but so this has been John Sechrest from Seattle Angel Conference. I don't know, we're spiritually aligned in terms of our organization in the sense that we think we can bring to early stage startups, angel investing, helping people create more angels, create more successful companies, create more startups, and kind of approach it with a rationale and a level head, where we don't all have to be like crazy VC pump and dump, nor are we all like going out of business or just starting hot dog carts. And look out for more programming from both of us. Check out the Seattle Angel Conference meetup as well as their website. If you have a startup that would be a good fit and you're in North America, apply. Their next cohort's deadline is February 24th. We will send links to follow up on that kind of stuff too, as well as a recording of this webinar. And yeah, John, any parting words?
Cool. I think the thing we didn't touch on that I think it's worth understanding is that 10% of the U.S. population is accredited, and 99% of them are not writing checks, which means there's a lot of people in your network who are maybe a little older and a little more college educated who are accredited that don't know what that means. And you should go get David Rose's book and give it to them as a unbirthday present, and let them wake up to the possibility of funding the innovation economy. And so tell the story of the innovation economy and how startups are making the future. And if you do that well, your network of accredited investors will grow much faster than you expect.
That's an absolutely fantastic takeaway. I worked in big tech. I went through Boeing, and I was one of the people John exactly talks about. I did not even realize I was an accredited investor when I became one, or that this was even an option to me. Had I not found Gust, I still might be ignorant to that fact. And David S. Rose is Gust founder, and I will put the name of there's two books that he's actually wrote: Angel Investing, Having Fun, and making a profit investing in startups. That's good for anybody who would be interested in that. And then the startup checklist, which is for the founder, just kind of what Gust and Gust Launch does, the nitty gritty, check the boxes, make sure you do the stuff. You file a corporation in Delaware. Usually you do stock grants with vesting schedules. You don't do, silly things like selling common stock directly to investors or anything like that. So check out both of those resources. Check out Seattle Angel Conference. Check out Gust.com or Gust Launch if you're not a customer already. And wonderful. Thank you so much, John. Thank you for your extra time and your patience with our fun little technology bits. And
Yep, cool.
have,
Thanks.
have a
And
great one,
when
everyone.
you decide to do this on Zoom, let me know and we can do another one.
Wonderful. Thank you.
All right. Thanks.
Bye, everybody.
Bye-bye.